Picture this, you're sitting in a cafe, sipping your overpriced latte, casually checking the markets, and suddenly it feels like you just walked into a drama series you didn't sign up for. Seven companies are on a glamorous world tour. Nvidia selling out stadiums, Microsoft doing meet and greets, Apple dropping surprise albums, while the others, 493 members of the S&P 500 are basically stuck backstage holding cables. The plot twist, this AI-powered superstardom is reshaping the entire market. So today we're unpacking how this magnificent seven became the main characters and why everyone else is stuck as background extras. So let's dive in. So let's set the stage here. Because once you look past the dramatic opening, the story gets even stranger. Imagine the stock market as a giant high school. You've got 500 students all wearing the same uniform, all pretending they're equally important. But walk into the hallway and you instantly know who runs the place. The popular kids. Apple's the overachiever with a mysterious personality, Microsoft the reliable class president, Nvidia suddenly the new celebrity everyone wants a selfie with, and Tesla is the kid who insists they are a genius but sometimes forget to do their homework. And then somewhere around the lockers you have the other 493 students quietly eating their lunch, minding their own business, and occasionally asking, are we still part of this? That's the state of the market right now. We are living in a moment where the Magnificent Seven aren't just leading, they are carrying the entire index on their shoulder like they're being pushed in some bizarre financial B class. According to Parnassus Investments, these seven stocks were up to 57% last year, while the rest of the S&P 500, literally 493 companies, managed around 13%. That's not a gap, that's a canyon in scale. And investors, of course, they're watching this like a Netflix documentary. Whoa, look at Nvidia go, they whisper, as if Nvidia can hear them. Look at Microsoft, look at Apple, and then someone remembers that version exists. So let's actually break down who these main characters are. You know the names: Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla. These companies used to be just a tech giant. Big? Yes. Influential? Sure. But after the 2023 AI explosion, they basically became the center of the economic universe. Morgan Stanley notes that they now make up over 34% of the entire S&P 500's market cap. Seven companies hold a third of the 500 company index. That's like being told seven people are taking up a third of the oxygen in the room. Technically possible, but it's weird. And it didn't happen slowly. It wasn't a long, graceful takeover. It was more like the moment ChatGPT dropped. Investors collectively yelled, AI is the future, threw all their money to tech, and the rest of the market was left blinking in confusion like, should we learn how to code? Now, performance-wise, the split isn't just visible, it's of course aggressive. Let's talk about numbers, because the numbers aren't shy. In 2025 alone, earnings per share growth for the Magnificent Seven is averaging around 30%, while the other 493 are cruising somewhere near 10%, based on an analysis shared through CNBC's Ha-Kyung Kim. Capital Group also points out the valuation divide. Magnificent Seven trades around 30 times forward earnings, while the broader market sits at 19.9. Translation for you, investors are willing to pay premium prices for these seven stocks, like their rare collectibles or maybe something like Taylor Swift's tickets or something like that. But here's the fun part, the 2025 trend is shifting in a surprising direction. Not all seven are still pushing the index uphill, only 5 gained this year. And for the first time in a while, the forgotten 493 have actually contributed around 59% of the S&P 500's 2025 returns, according to Capital Group. It's the plot twist nobody expected, like the background characters are finally getting their lines. So why did this whole divide happen in the first place? What created these market versions of rich kids versus normal kids? Simple, it's AI mania. These 7 companies have been shuffling billions into data centers, cloud infrastructure, chips, compute power, all the backstage machinery that makes AI even possible in the first place. Nvidia alone projects AI related spending will hit around $4 trillion by 2030, which honestly sounds fake and unreal, but apparently it's not like that, according to Capital Group. When you're building the roads, the highways, and the cars for the AI revolution, investors don't just pay attention, they bow to you. Meanwhile, the rest of the S&P 500 is facing problems that don't sound nearly as glamorous. Tariffs are pushing up import costs, higher labor costs, slowing consumer spending. Some industries are basically running a marathon right now while carrying a backpack filled with bricks. Morgan Stanley even highlights that sectors like airlines and retail are getting hit disproportionately by these economic pressures. Then there's the psychological part, because humans investing money are, well, unfortunately still humans. Herd behavior kicked in. Someone somewhere made money on Nvidia, told their cousin, the cousin told their barber, the barber told the guy in the chair, and suddenly we have a market where everyone is convinced owning big tech is the only responsible adult choice. Bloomberg calls it an obsession with big tech, and honestly, it fits. People are treating these stocks like comfort foods. But let's rewind a bit. If 7 companies are this dominant, what does it mean for you, for all of us? The investor who'd probably like to sleep peacefully at night without worrying the market will implode if Nvidia sneezes. There are risks, obviously. A top-heavy index is fragile. Morgan Stanley has warned that markets like this are historically more prone to sharp drawdowns. Think .com bubble but with better UX design. If even one of these companies misses earnings or disappoints guidance, the whole index gonna shakes. But on the flip side, and this is where it gets interesting, there are massive opportunities in the so-called 493. Many of these companies are trading at more reasonable valuations, offering actual value instead of pure hype. Capital Group notes that the broadening in the market returns indicates healthier participation, meaning you don't have to rely on the same 7 names anymore. And for DI itself, it's spilling over. The second wave of winner is already emerging. MarketWatch lists names like Broadcom and Oracle as rising star in AI infrastructure. These aren't fancy consumer-facing AI darlings, they're the companies selling the picks and shovel in the gold rush. For investors, the strategy is surprisingly timeless: diversify. Apollo Academy study suggests overexposure to AI or tech can backfire to you, so mixing in international stocks, energy, industrials, as even the boring ones can create a healthier portfolio for you. Now let's look ahead, because every financial story eventually arrives at the "so what happens next?" Analysts from bar chart and others expect Mag 7's growth edge to normalize around late 2026 as earnings from the rest of the S&P 500 catch up, boosted by broader AI integration and potential policy shifts like tax cut or reduced tariffs. Capital Groups points out that industrials and financials could get sizable tailwind from these macro changes. But the other scenario is equally possible. Big tech company keeps dominating. Bloomberg warns that if investor obsession persists and AI innovation continue at this pace, the Magnificent Sevens may remain the main characters indefinitely, like a show on TV that refuses to end because the ad revenue is just too good. So, what does this all really mean? Simple. The market is polarizing, but it's not broken, it's just evolving. The Magnificent Seven may be sprinting today, but the rest of the market isn't dead, it's warming up. And for you, of course, this is the perfect time to understand the story, not blindly chase the hype itself. Because in markets, knowledge is leverage, and leverage used wisely is a power. So, as we wrap this up, let's take one last look at the market's current episode. 7 companies sprinting like they're auditioning for the Olympics, and the others 493 are casually stretching on the sidelines. It's absurd, it's impressive, and honestly, It's one of the strangest financial storylines I've seen in years. But that's the beauty of the markets, they evolve. The Magnificent Seven won't stay invincible forever, and the rest of the index isn't doomed to be the background extras forever. Momentum always shifting, cycles turns, underdogs get their arcs. What matters is that you don't get hypnotized by the headlines. Big tech company looks glamorous, but it also concentrates on risk. Meanwhile, the boring companies might quietly deliver the plot twist no one expects. Broad breadth, narrow leaderships, AI boom, market fatigue, they're all just chapters, not the whole book itself. So whether you're cheering for the superstar or scouting opportunities in the supporting cast, the smartest move is staying informed and staying balanced. Don't chase the noise itself, understand the narrative. Thanks for watching, stay kind, stay curious, stay critical, and may your portfolio behave better than Tesla's quarterly earning calls. See you at the next one, bye bye.